Does having a car loan impact your chances of getting a mortgage in Canada? If you are eyeing a new home but already have a car loan, this is something you can't afford to miss. In Canada, car isn't just a luxury, it's often a necessity. With tough winters and limited public transport, many newcomers find that buying a car is one of their first big purchase here. Whether you get a brand new or a used car, chances are you will need a loan unless you are buying that car full in cash. A car loan, which is considered to be a form of installment debt, means that you have fixed payments over a set period of time, usually between 3 to 7 years. Can it really stand in the way of your dream home? Some experts say you should avoid taking out a car loan before buying a house. But is that true for everyone? Should you rush to pay off your car loan, or can you still qualify for a mortgage without any issues? I am about to break it down for you with real numbers and insights with my home buying planner. But before we dive in, make sure to hit that bell icon and subscribe to this channel. So here is in front of you my mortgage pre-approval calculator, which will do the actual calculations for you, and we will able to find out that whether a car loan can actually affect your eligibility to get a mortgage for your first home in Canada. So we will be considering two scenarios for this example. One is when we are putting less than 20% down to buy a home, means when it is an insured mortgage. And second scenario will be when we are putting at least 20% or more than 20% to buy a home. So let's start with the first scenario. In this case, I'm assuming that purchase price of the home is $750,000. So to buy a $750,000 home, the minimum down payment required is $50,000. For this example, I'm assuming that we are putting 10% of the purchase price, that is $75,000. So on the basis of this minimum down payment, the mortgage default insurance would be around $20,925. So when you are putting less than 20% down, you have to incur the cost of mortgage default insurance. This insurance premium gets added to your mortgage required. So in this case, the total mortgage that we require is $695,925. Interest rate, I'm assuming it to be 5%. So when the interest rate is 5%, the minimum qualifying rate would be 7%. So as per the mortgage stress test, the lender makes you eligible on the rate that is 2% more than your actual contracted rate, or 5.25%, whichever is higher. So in this case, your qualifying payment would be around $4,874. Amortization, I'm keeping it 25 years. And for an insured mortgage, it cannot exceed 25 years. So monthly housing cost comprises of your property tax and minimum utilities, which a lender considers while approving your mortgage. And your actual mortgage payment, that is your principal plus interest payment for this mortgage, would be $4,047.53. So after inputting all these figures, this calculator is showing us that the minimum income or the ideal income you require to buy this home of $750,000 with $75,000 of down payment for around $169,019. So I am assuming that we have the same income. So I'm just rounding off to the next number. I'm putting $169,100. So just have a look over here under the GDS, that is gross debt service ratio. So a lender calculates your eligibility on the basis of two major ratios. One is GDS, that is gross debt service ratio. So the GDS ratio includes your monthly housing cost, which includes your mortgage payment, your property taxes, your heating, or 50% of the condo fee if you are buying a condominium. So as per the mortgage standards, your total monthly housing cost, that is GDS, should not be more than 39% of your gross household income. And particularly when it's an insured mortgage, that is where you are putting less than 20% down, it cannot exceed 39%, because the mortgage default insurance providers such as CMHC have set the limit that they will only be approving for the mortgage default insurance where the GDS is less than 39%. So now with this income, we are good with the GDS since it is lesser than 39%. Now let's come to the second important ratio, that is TDS, which is total debt service ratio. So as per the mortgage standards, your total monthly debt should not be more than 44% of your gross income. So what TDS includes? It includes all of your housing costs, including your mortgage, utilities, property taxes, and on above of that, whatever your car loans, your credit card balances, lines of credit, student loans, or any other debt you have, combining all these debts, it should not be more than 44% of your annual gross household income. So now in this case, it is sitting at 38.98%. It means even if we have any monthly debt payment, we can still be getting approved for this mortgage of $695,925. Let's assume in this case that you have a car loan payment of $500 a month. So under the monthly debt, I'm going to input $500. So even after putting $500, the TDS is coming out to be 42.53%, which is well within the mortgage standards, that is 44%. So this example proves that if you are going for an insured mortgage, even if you have a monthly debt, or as per this example, a car loan of up to $500, you can still be getting approved for a mortgage. So talking about this particular example, even if the total monthly debts are ranging up to $700, you will still be good to getting approved for this mortgage. But here, I just want to give you a heads up. Although as per the mortgage standard, you will be getting approved for a mortgage because your ratios are below the mortgage standards. But a higher TDS ratio means you are increasing the risk of taking on more debt that you can afford. Always keep yourself well below your maximum limits. Never stretch yourself to the maximum what you can get approved for. Because in the future, your housing costs can increase with the increase in the property tax in future, with the utilities or other repair and maintenance that you'll be undertaking for the property. So let's move to the second scenario where we are putting at least 20% or more than 20% to buy this home. So where you are putting at least 20% down, it is called a conventional mortgage. So here in the down payment, I am assuming that we are putting actually 20% down, that is $150,000. So now see, with $150,000, there is no mortgage default insurance premium that you need to pay. And the mortgage that you require to buy this home is $600,000. I'm keeping the interest rate and the amortization as it is as per the last example. So now with the only change in the down payment, you can see the ideal income that we need to buy this home is $148,346. For this example, I'm assuming that we don't have that much of income. And let's suppose that our household income is $140,000. So I'm going to input here $140,000. So now if you can just come down here and look at the GDS. So GDS is 41.32%. Cannot be more than 39% in case it's an insured mortgage. But when you are putting 20% or more than 20% down, in that case, a lender may still qualify you for a mortgage, even if your GDS ratio is slightly higher. Again, mentioning here, a higher GDS ratio means you are increasing the risk of taking on more debt than you can afford. But if you're stretching yourself to the maximum of your budget, then it can happen. Now we take the same example as previous, that we are having a $500 of car loan payment. So I'll just input $500 over here. Just have a look at the TDS. Now with this $500 of monthly car loan payment, the TDS is now surpassing 44%. In this case, it is coming out to be 45.61%, which is going above the mortgage standard of 44%. And even the lender might not be comfortable to approve $600,000 of mortgage with this higher TDS. What's going to happen in this case? So two scenarios can happen. First, the lender will be approving you with the lesser of the mortgage if your annual income is going to stay as it is. So if I'm keeping my down payment the same, which means I have to reduce my purchase price. So I'm just reducing my purchase price by $30,000 to $720,000, for which now the mortgage that we require is $570,000. So now if you see, with the reduced amount of the mortgage, the TDS is coming well within the standards, that is 44%. Now you can get approved for this mortgage of $570,000, which means a car loan of $500 has now reduced your borrowing capacity by $30,000 in this case. Or we can take the other scenario. If you still want to buy a house of $750,000, what you need to do is you need to increase your down payment. So from $150,000, at least you have to put $180,000 so that the mortgage required can come down to $570,000. So in a conventional mortgage, where you are stretching yourself to the maximum of your limits, a car loan payment can actually affect your eligibility to get a mortgage. So after seeing both the scenarios, however you are getting approved with the first scenario where it's an insured mortgage with a car loan, or not getting approved with a car loan in the second example of the conventional mortgage, I always recommend that never stretch yourself to the maximum of your limits. Why? Because a lender calculates your eligibility for a mortgage on the basis of your gross income. So out of this gross income, you still have to pay your taxes. And it is the net income with which you have to pay your mortgage, not your gross income. So as per my recommendation, the total housing cost should not be exceeding 28% of your gross annual income, so that you have ample room available for servicing other debts or making savings towards the future. Hope you were able to get some clarity on whether a car loan can affect your eligibility for getting a mortgage or not. If you like this video, share it with your friends and don't forget to subscribe to this channel. Thank you.